لا تنسوا الاعجاب بالفيديو والاشتراك في القناه.
Welcome to part 5 of our seminar, Understanding Financial Statements. In this video, we provide insights and understanding of intangible assets and the asset classification, other assets. Please make sure to print the PDF handout found below this video. We will be referring to the PDF handout throughout the seminar.
Okay, now we're going to go to intangible assets. Intangible means not physical. We can't touch it, right? So intangible means not tangible. And it would have to have been purchased for us to list it here. Again, because of the cost principle. The accountant's cost principle says record assets at their cost. So for example, if we develop the trade name accountingcoach.com, and that domain name and the name itself is worth a ton, I can't list it on my balance sheet for Accounting Coach because we didn't spend anything to buy that name. $12 for the domain name purchase perhaps, and a few hundred to get the trademark, but that's it. So the most I could show is a couple $100. Now, and I may have just expensed that initially or wrote it off by now, so I may have no cost there for the trade name of accountingcoach.com. And it might be the most valuable asset that I own. But cost principle says you show what your cost is, not what you think it's worth. We're getting into subjectivity. Who would know what it's worth? You know, all over the map, right? Nobody would know. Okay, now goodwill is another example we list here. Goodwill is something that occurs when a company buys another company. So let's say I bought a coffee shop in my hometown, in a strip mall. So the person that operates that rents the space, and they want out of the coffee shop business. And I want to buy it. So I say, I'll buy your business. And they'll say, fine, here's the price, $30,000. You can buy my coffee shop. I said, what do I all get for the $30,000? And they say, well, you get this espresso machine, you get these tables and chairs and the silverware and this stuff in the cabinets and the display counter and a cash register, and that's about it. You can't have the building because I don't own the building. I'm just selling you the business, right? So if I pay $30,000 for that business, where do I put that on my balance sheet? And I look at those tangible assets I bought, the used counter, the used cash register, the used everything, and I'd say $5,000 maybe is the value. So I assign $5,000 to all those pieces of equipment and then later depreciate those. And the difference between the $5,000 of fair value for those tangible assets and the $30,000 I paid, that difference of $25,000 is called goodwill. And I put that goodwill on my balance sheet. So that would occur, a goodwill would occur only if you purchase another item. But the trade names and mailing lists might come up more often if you purchase them, though. You got to purchase them for them to be on here. See? So you don't have goodwill unless you bought another business, and you don't have anything on this line trade names unless you bought a trade name. If I just develop my own trade name, it ain't on there. Right? So again, on trademarks, for example, Coca-Cola developed that logo, decades ago, and so that logo is probably the most valuable asset Coca-Cola has and their formula. But that logo all around the world means, oh, I'm going to buy a Coca-Cola product. Right? So that's probably their most valuable asset, but I bet it's not on their balance sheet because it probably got started in the first half of the 20th century sometime, somewhere in the early 1900s or something. They probably developed that logo. Nike's little swoosh is very valuable, but they didn't buy that from anybody. Right? They had a contest, I understand, at a college, and some young lady at college got a little stipend for coming up with that suggestion, and they bought it. And now that's probably worth billions of dollars, right? But you won't see it on their balance sheet, right? So again, it's the cost principle, right? And objectivity, etc.
Would a patent be an intangible asset?
Yes.
So you record your costs for filing and getting the patent?
Yes. Question.
The research that went into getting
Right.
the patent.
Yeah, I'm not sure about that.
Okay.
So the question is a patent an intangible asset? Absolutely, but you can only put down the cost of the patent. And so the cost of filing and whatever had to do preliminary work would go on here. And any cost to defend your patent, I think you can add to this. So if you spend $1 million to defend it, that's another cost of the patent. Now your research and development that you spent developing that, research and development must be expensed when incurred. So perhaps in around the 1980 era, the accountants set a rule. The Financial Accounting Standards Board is the current group that sets the standards, and their second pronouncement said all R&D is going to be expensed when incurred. And I think they wanted uniformity, and also there's that subjectivity and conservatism that's behind some of this. You know, how do we know if that research and development will even get to be a patent? And then if we get the patent, how do we even know we're going to get to sell any of it? And so, whoa, we better not hold these on our balance sheet, hoping that in 20 years we're going to have a product that we can expense it against. So we like to match it against revenues. But if we don't know how to measure things, boy, we're going to have to expense things sooner, right? Because we want objectivity and then the conservatism. When doubt exists, you go with the more conservative. So as I think about it, they shouldn't have even had to write that rule. We should have just done that automatically under conservatism. But I suspect that big corporations needed to get their earnings up one year, and they said, hey, let's defer some of this R&D because that's going to be a product that's coming out next year. And another company was more conservative, and they said, we're not going to do that. And now the poor financial analysts are trying to compare two companies. Right? And here's one company being very conservative in their accounting, another company being very aggressive. And now we've got havoc in the financial markets, and we want efficiency in our markets. So the accounting board, Financial Accounting Standards Board, I suspect, made that rule to have comparability between companies in the same industry. Okay, great questions. So now we go to the last category or classification called other assets. And this is often labeled deferred charges even. And that's exactly what it means, deferred charges. Something we didn't want to expense yet that we're going to spread out over many years, kind of like depreciation, but we call it amortization. And an example would be our organization costs for our corporation. We had to pay a lot of money to attorneys and registration people in states and whatever, and we incurred a lot of money there, and we might say, let's spread that out over 5 years because that's what the tax people do. That's a crummy logic, but that's what happens. So organization costs might be down there. Bond issue costs, if a company is going to, let's say large utility is going to issue $100 million of bonds, and they have to spend a lot of money getting audits, legal paperwork, registration with the Securities and Exchange Commission, and that package of extra costs might be $1 million. Well, we don't want them to expense the $1 million on the day the bonds got issued, and we don't want to expense when the bonds mature, so we say defer it to other assets and then amortize that issue cost of $1 million over the 30 years of the bond. So it's going to look like part of the cost as well as the interest plus this. So if we spread that evenly over the 30 years life of the bond, that's more logical. So this is a place that we're going to defer some things that are longer term, right? It's kind of like prepaid insurance in a way, except that prepaid insurance was a short period, so it's up on top. This is a long period. It's going to be spread over years. So we're going to stick it somewhere, and the place is, by default, other assets. Okay? Okay, and again, this number would go down as we move some of this to the income statement. Right? So this number, just like prepaid insurance, is going to be declining each year as we move 1/30 of the bond cost off the balance sheet to expense. So this number should eventually get down to 0. It's just a place to hold things before we send them to the income statement. Okay, then we have the grand total for all the assets, $527,323, and that total is going to have to equal the total of the liabilities and stockholders' equity. Remember our accounting equation here, assets equals liabilities plus stockholder equity. So the $527,323 total asset amount is going to have to equal the combination of those liabilities and stockholder equity amounts.